partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
All right, I've got Greg Roberg here back with us on the Moving Iron Podcast here from AgDirect. And Greg, how you doing this morning?
I'm doing good, Casey. How are you? See your Chiefs hat on. It's a big win for
Chiefs, baby.
Chiefs fans.
Big game. Super happy. No, it was a good game. Watched that. I was expecting to see a pretty good game, and that's what we got. So it was a pretty evenly matched game back and forth there. So I like when it goes like that. Yeah.
It was a lot of fun.
Absolutely. So, Greg, let's talk a little bit about what's going on over at AgDirect, man.
All right. Well, just wanted to say, coming off a pretty good January, not as good as the last couple of years. I kind of expected that just with some lower inventory levels. We're hearing out in the market that dealers are starting to get a little bit more inventory from the manufacturers. So February is going a little bit better. Interest rates obviously are a hot topic.
Yeah.
And we've seen 3 to 4% increase in rates over a year. I've been at this over 20 years and never seen that before. Mm-hmm. So they're all kind of trying to adjust to the new normal. Fed raised rates here early February 1st. They meet again until the 22nd of March.
Yep.
And then they take April off, come back in May. So everyone's kind of expecting another quarter of March and kind of see what May brings. Some good news, though, is AgDirect lowered their rates on Monday, and so fixed rates. So in a position to do that, so I think dealers are going to find that AgDirect is more back in the game than we have been for a while. So to bore over listeners with how we get our money, but AgDirect gets its money through the bond market. So what that means is when the Fed meets and raises rates, we're the first ones up, but when rates start kind of plateauing or leveling out or even going down, we're the first ones that can make an adjustment. So we're in a position to lower rates, and we really hope that dealers and producers take advantage of that. Because right now, fixed rates are kind of the name of the game. They're actually lower. Fixed rates are 7-year rates lower than our variable rate, which is just kind of sign of the times, which is kind of extraordinary.
Yep. Yeah. No, I tell you what, the interest rate thing has, like you just said, we've seen 3 to 4% increase over this year, and what that looks like and how that's affecting the marketplace. Greg, as you talk to your dealers out there, what are they telling you, and what are you seeing out there as far as, I guess, we saw a big run up in inventory and those kind of, or decrease in inventory last year, and we're starting, like you said, we're starting to see a little bit show back up on the lots here. Not a bunch, but funny conversation I had with the guy the other day. He was all panicky about what he was going to do with all this inventory, and I said, "How long have you had it?" And he said, "Well, I've had it for about a couple weeks." And I'm like, "Got to calm down here. I mean, you're going from selling everything as fast as you can to now it's on your lot for 2 weeks and you're panicking." So you're starting to see some of that I don't know what's the best way to put that, but a little bit of a anxiety. There you go. Anxiety in the marketplace because of what you're seeing. So I guess some of the conversations you're having, Greg, are you seeing a similar thing? And do you see some panic out there a little bit with these dealers you're talking with? Or anxiety, I guess, is probably the better word to use.
Well, yeah, probably what we hear more to do is inventory, because there's plenty of buyers. There's a lot of cash on the market. Sure. And particularly through the Midwest, grain prices have been really strong for the last couple of years. And so our biggest competitor in AgDirect, and I imagine a lot of lenders would say, is cash. particularly up to maybe 150, 200,000. A lot of folks are just writing checks. It's true cash purchases. You start getting over 200,000, half a million or more. There's some financing, whether they finance all of that or half of that. That's where a lot of folks are still borrowing some money. So, lenders have different programs to incent salespeople or incent the dealership. And so when customers write checks for cash, that's a good indication that there's financial health out there in the farms, but that can kind of disrupt some different programs and targets that dealers are trying to hit. So with all that said, I think with more financing here as things kind of settle out with maybe crop prices come down just a little bit, increases in new equipment, which drives used equipment. I think we'll see some more financing. Biggest question we hear then is, well, I've got guys that trade me 2 to 3 years. I don't know how they can afford the next one. And so we're starting to hear more about leasing. And the majority of leasing that AgDirect does is what we call lease to own. And so the residuals are higher, so the payments are lower. So you can, make your cash flow work better. And our lease is very flexible, which means you can trade out of that equipment during the lease and with no penalties. But if you let it go to the end, you got to either buy it or trade it. So it's not a walkaway lease; it's a lease to own. But it makes it a lot more affordable, Casey. And so that's the most popular lease we have at AgDirect. It's 80% of the leasing that we do is that lease to own. And so a lot of sales people are saying that might make sense for some of my farmers that are coming in and saying, "Hey, I want to trade, but I got a little sticker shock."
That was my next question for you was about the leasing and what you see happen there, because I've seen more people start talking about the payment structures that they're looking at and how those flow together, and that's where leasing really shines, is when you start looking at payment structures and developing that payment and how it goes through the life cycle there, and cash flow and all that kind of stuff. So
cash flow is the game. When we have opportunity to talk to actual producers, we try to coach them, educate them that sometimes writing a check, particularly for 100,000 plus, isn't always the best idea. Maybe finance half of that, protect working capital, because the farming's cyclical, and there's good years followed by some tougher years, and working capital is so important to get through some of these tough years. We talk about rates. I just wanted a quick mention. AgDirect doesn't have any prepayment penalties, so that's something for your listeners to think about. Right now, our rates are going to be our 3-year is the same rate as our 7-year. So the yield curve is very, very flat. It's inverted, meaning variable money is more expensive than 7-year money, but 3 to 7-year money right now is about the same. So if folks are looking for cash flow, I'd say look at our 6 or 7-year rate, because it's really competitive, and you can pay that off at any time without a penalty. So there's some options. We hang our hat on AgDirect being simple, fast, flexible. I think right now, flexibility and being able to make decisions for your own operation is key.
Yeah, right on. Well, Greg, good talk here, man. I really appreciate you coming on. If folks want to reach out to AgDirect and get more information about what you guys doing, what's the best way to do that?
2 best ways: either go to agdirect.com to see our rates. You also can go see our rates and do some payment calculations on AgDirect Mobile, which you can just download for free. Or we love to hear from you, and call us at 888-525-9805, and somebody will answer the phone and get you taken care of.
Right on, Greg. Greg, I appreciate you being on, man. Take care of yourself.
Hey, good seeing you. Thank you.
Hello, and welcome to Moving Iron Podcast. This edition of Moving Iron Podcast is brought to you by AgDirect. It's built for today's agriculture with simple applications, quick response, competitive rates, and generous, flexible terms. AgDirect offers buy, lease, and refinance options on almost all types of new and used equipment. Non-recourse and timely funding back to your dealership, plus sales incentives. No other ag equipment lender works like AgDirect. Learn more by calling your AgDirect territory manager at 888-525-9805 or visit us at agdirect.com. I've got Tanner Ehmke on here back from CoBank. He's back on for his monthly chat. So Tanner, how you doing, man?
Doing all right. Good to be back, Casey.
Good, man. I'm glad to have you back. So we got, I think, a couple big things I think that are notable to talk about, all kind of hovering around the economy and what we see happening there. One is We had some fireworks on the inflation rate that came out here last week.
Yeah.
Kind of talked about what we
Yes.
saw there. And with your expertise being in dairy, I want to hit on that a little bit too. So let's start with interest rates first, and inflation rates and what that looks like. So we had the inflation rate come out, and it was down from where it was in December. But the big to do was the intermonth growth in inflation. And just previous to that report coming out, the Fed had come back and they said, we're going to raise a quarter rate, kind of feel where we're at, kind of readjust and see where we're looking and see what's going on. Well, I think they got a pretty good picture of what they're taking a look at here. So Tanner, I guess what's your response to that, and how do you see this moving forward?
Well, the number this morning, 6.4%, was quite a bit higher than what the market had been anticipating, and I'm sure that's probably a lot higher than what the Federal Reserve had been anticipating. Because, as you mentioned there, Casey, the intermonth increase was by quite a bit, is half a percentage point, and that was up from the December increase, which was 1%. And that had been the lowest since for a few months. It had been steadily coming down the last several months, showing steady progress, which had given, I think, the Federal Reserve this false sense of calm that, hey, we're doing our job. We're bringing prices down by raising interest rates, and they've been raising rates since for the past several months, by a half a point in the last several meetings. And then this last meeting, they raised it 25 points, basically signaling, okay, we see the the inflation numbers are calming. It looks like our interest rate increases are having the desired effect. But now the numbers this morning are a little bit concerning. And perhaps the Fed does not have their hand on the wheel like everyone thought they did. Because remember, there's a lot of other things are impacting inflation. It's not just interest rates. For so many months or years, really, we had supply chain issues that were driving inflation numbers. We had labor issues that are still a problem, but wages had slowed down. And so that is intermixed with the rising interest rates. And so a lot of those problems, especially with the supply chains and transportation rates, have really calmed, and those inflationary pressures had gone away for a lot of the economy, leading us to believe that, well, look, the Federal Reserve has really gotten this under control. They know what they're doing. Well, this morning, these numbers really call that into question. Perhaps the interest rate increases that the Fed has done so far have not had really the complete desired effect. The inflation numbers weren't as low as the market had anticipated. And so this raises the issue again of how high for how long on the Fed funds rate. And the Fed kind of put themselves a little bit in a position in the last meeting when they raised it 25 points, because they're not going to come around in the next meeting and bump it up to 50 points. They're going to be steady as it goes. They don't want to shock anybody too badly, at any rate. And so what this perhaps does is it leaves the Fed in a position of maintaining a path of raising rates by 25 points for the next several meetings. And Jay Powell had already indicated in the last meeting that at least a couple more times would be a couple more rate increases are in the offing. I think right now, given the inflation numbers this morning and the very, very strong jobs numbers that had came out before that, all point to the fact that the Federal Reserve's rate increases have ultimately not slowed the economy down enough. And they're probably going to have to maintain this path of further rate increases, at least at the bare minimum, for the next couple of meetings, perhaps, into well into the second half of the year, perhaps. But we'll see. We're going to see what the data says coming in. But with the numbers as high as they were this morning, I think the Federal Reserve is going to be taking this very seriously about maintaining a path of at least 25 basis point increases, at least for the next few meetings.
Yeah. right. So what's your thoughts there, man? I mean, I'm looking at this stuff and I'm watching, I bought my house at 2.75% interest rate, whatever it was 3 years ago, whenever it was I moved into my house. And, to get the same house today, you're looking at, 6.5% interest,
6.5.
kind of,
Yeah.
yeah. And so, you're tripling the amount of the interest payment that you're paying by doing that, pretty close to that level. I mean, 2.5 times for sure. You take a look at that, and I still see houses that are being sold at above ask price. I still see houses being pushed around. There's pockets of places that you see, see some slowdown, but you still see a pretty strong housing market out there, even though with interest rates the way they are. What do you think some of this driving factor? I mean, 'cause it's not like wages have gone up to meet the inflation point.
No, they haven't. Wage growth has not really been keeping up with inflation at all.
Yeah. So, I mean, what's your thoughts there?
That's a problem.
Yeah.
Well, a couple of things on that, Casey. One, we've got a very tight housing market.
Right.
And so even though you raise the, the cost of borrowing, it's a situation for homeowners.
Right.
Yeah. The housing market may be strong. Do they want to sell? And if you look at the borrowers, a lot of people have been pushed away because of the rising interest rates. And so the market isn't going to move much because if you do sell, you're going to have to go buy another house someplace else. And so that has further kept the housing market even tighter. And that's why housing prices haven't come down, and people's home equity still remains fairly elevated. And so that has perhaps given people, consumers, a false sense of wealth, that their home equity remains elevated. But at the same time, you brought up wages. That's a problem. The wage growth has not kept up with the inflation. So real wages is actually negative. The real wage growth, when you subtract the inflation rate from the wage growth rate, that gives you real wage growth rate. And people have been taking pay cuts. And so I think we have to keep an eye on what that means, especially in food and agriculture, because consumers are going to have to cut around, at least on their durable goods, and then they're going to start trimming where they can on their food. And what that means in the grocery store, we've kind of already seen this play out now for the last several months. People going to private label, people buying more efficient bulk packaging, or in some cases, if they just don't have the dollars, they have to go to smaller packages. People going to commodity products rather than premium products. All of those things consumers have already been doing, shopping at big box stores, and then instead of boutique retailers. That's what they've already been doing. And now with the inflation numbers as high as they are, that's going to push even more and more people into this situation where they're going to have to really start getting very smart on their dollars at the grocery store. And food is a hard thing to cut. I mean, you can perhaps push back your mortgage a few months. You can work that out. You can hold off on paying your rent, but you can't hold off on eating. And for better or for worse, that's good for us in agriculture. Consumers still have to eat. Not that we want to take advantage of that, but I think we can find solace in the fact that everyone in agriculture knows that they're needed. You can't go without a farmer, and you can't go without food for too long.
Right.
So I think perhaps here we have, in a lot of the food and agriculture sector, some recession-proof products. I know in dairy, the sector that I cover, a lot of dairy products are recession-proof. Some products are going to be more flexible. For instance, butter. Butter has certain replacement or alternative products. Instead of cooking with butter, you can cook with vegetable oil, things like that, or margarine. There are cheaper alternatives out there that have the similar function in the kitchen. People are definitely going to be cutting back at restaurants even more. So I think these trends that we have seen for the past several months of the consumer hunkering down, that is only going to continue further into the year. Now, turn the conversation back to the Federal Reserve and the job they have at hand. They're going to continue to keep raising rates for those of us who have to borrow money, for those of us in agriculture, especially where you're paying more on your operating loans for agribusinesses that may have CapEx projects. The cost of doing those projects, your interest expense is going to keep going up. There's only one direction really conceivable that is where that's going to be going. So the cost of borrowing is going to keep going up, and I think the sentiment out there that we hear in the industry from borrowers, from other partners in agriculture, is that people are cautiously hopeful in that materials costs are going to come down, but the borrowing costs are going to keep going up, and so it's going to be more of a story of interest rate management for borrowers. But at the same time, for some companies that are perhaps looking to expand or making an acquisition, if the Federal Reserve keeps raising rates and potentially pushes the U.S. economy into a recession, that might create acquisition opportunities for some in business, in agribusiness, or perhaps even in agriculture, with farmers looking to buy that piece of land across the road if other farmers can't afford it. So a whole lot of things here where you can't just say that rising interest rates is entirely bad. It depends upon what your goals are. It may create opportunities as well.
Right on. Okay. All right. All good points there. I think lastly, the one thing I kind of want to talk about just on this subject just real quick is just some of the stuff that was in the mix that showed that inflationary thing, which kind of goes back to what we talked about here. Rent was being one of those at the tight housing market. Even if you want to rent a house now, you can't hardly find a house to rent either. I mean, they're about as picked over as anything else is. But energy was the other thing that was there. So talk on the energy side, we've seen the price of energy really dramatically drop. And, we've seen some rises here a little bit, but it's still kind of hovering around that 80, mid 80s range, somewhere in there. So I guess where was the big influx in energy that caused that inflationary jump, do you think?
Oh boy. Well, I'm not an energy analyst, so I only know what I read. I think, as you pointed out, rates have been coming down. Natural gas prices have been coming down. Now, at the home level, for the natural gas that's going into your home, your heating costs have been sky high, and I think that's more of a situation where the falling nat gas prices, for instance, have not flowed through yet all the way down to the rate payer, because that nat gas was bought and now it's got to be delivered, and so it's got to flow through the pipeline, and by the time it gets to your home, it may be a lower price later on. So it takes a little bit for those prices to ultimately reach the consumer. So I think that's a part of it. And our energy analyst at CoBank, Terry Vishwanath, would give you a lot more in-depth analysis on that. She can talk for several hours at a time, and she would love to do it. But that's one of those things where, although we've seen spot rates on crude oil and nat gas come down from their peak several months ago, sometimes it just takes a little bit for those prices to flow through. But from what I understand, really, it's the housing side, the rents. Those rent controls came off several months ago, and so after the pandemic, and so I think landlords are probably trying to catch up for lost time, maybe, and so that might be pushing some people into financial insecurity. But again, there's a lot of moving parts there. One thing I would point out, this is something that a lot of people are not talking about, is that as interest rates are going up, some of these delayed payments on debt are going to be activated later this year, like student debt. Okay. So consumers are being squeezed now by inflation. They're being squeezed by rising interest rates. And now for so many consumers, they're going to be hit with a third one here, and that is student loan payments that were put on pause. They're going to get reactivated. So we're going to see the U.S. consumer squeezed here in the next several months if we don't see inflation come down sufficiently. So that alone might be the trigger that sends that this trifecta of events into or causing the U.S. economy to go into recession. And a U.S. consumer that just doesn't have cash anymore, and they're going to have to start borrowing credit cards. They have to, on their credit card numbers or debt loads are already ticking up again, and that tells you the consumer is, for a lot of people, they've run out of cash.
Yep. No, all that's fair, because you read the reports about credit card debt and those kind of things, and how much it's gone up month over month over month. So yeah, that's a good point. All right, let's talk about milk for a little bit. So milk, the price of milk right now, class 3 milk, has really fallen off dramatically, and that's to put it nicely. It's really come down from a 21 to 22 range down to now we're looking somewhere in the low 17s, kind of hovering around. I saw some 17, 29. Yeah, and they're floating around a little bit. So at that point, no one's making any money producing milk right now. So I mean, it's just, that makes it tough. Then you take a look at what's going on at the consumer level. When you start looking at stuff at the grocery store, every time I go to the grocery store, for whatever reason, the dairy side of the grocery store is the least stocked. It feels like whether it's milk, butter, cheese, yogurt, whatever it is, all that stuff just struggles. So I guess, talk a little bit about what's happening in the milk market there and what's driving this. Where was that? I mean, I know China has a lot to do with that, and powdered milk and all that stuff, class 4 powdered milk, and those things are all starting to play into that too. But as this stuff starts to open back up, I mean, do you see some light at the end of the tunnel here, I guess?
So to the point, yes, milk prices are down a lot. And how does that compute when you've got short on dairy products in the grocery store? What's going on there? That's a logistics supply chain issue, or the grocery store lacking labor to stock the shelves. The supply is clearly there, as indicated by price. So what is going on the price of milk and dairy products, which globally have been under pressure? Again, that's not really flowing through so much on the CPI numbers yet. That takes a little bit for those numbers really to cascade down to the consumer. But globally, we're seeing milk prices come down. One of the big contributors is the fact that China is producing more milk. The Chinese government is very aware of the ESG initiatives in Europe and New Zealand to reduce methane emissions and thereby reducing cow numbers. And so that has sufficiently scared the Chinese, who are the biggest dairy importers in the world. And so even though it may not be making money to produce milk in China, the government has subsidized it and tried to turn the knob on that and increase production in the face of this declining or the threat of declining production in Europe and New Zealand. So rising milk production in China is a big one. At the same time, the weather over in Europe has been very, very benign. It's been a fairly warm winter there. And so their productivity has increased. Farmers are still getting paid high milk prices by their co-ops. Even though world price of milk has come down, European farmers are contracted at different levels right now, and so they're still incentivized to grow production. This is coalesced with the warmer weather there. So you've got production across the board there, really strong production in the main producing countries, especially like Germany and France and Britain, all showing strong increases in milk production there. And then at the same time, the European economy is struggling, and so consumption is down a little bit. And so that pushes even more European dairy products onto the export market at a time when the Chinese are producing more milk, and that creates a supply-demand imbalance. Less demand coming out from China, more supply coming out of Europe, and then here in the United States, same thing. We have we have had at least a steadily growing herd up until the last milk report. We saw the U.S. dairy herd come back a little bit because cow slaughter is starting to pick up. That's a big reason, but productivity continues to go up as well. And so we've got sufficient milk supply here in the United States at a time when we've got plenty of supply globally. And so now we are seeing milk below cost of production. And that ultimately is going to cause some pain for a while for the U.S. Dairy farmer. And ultimately, that's going to catch up with European farmers as well to reduce their production. But that's going to take a little bit, unfortunately. So a lot of things going on there as to why we see falling milk prices. At the same time, feed costs are still fairly elevated, unfortunately. And so that is really going to impact the farmers' cash flow, and their feed is not what it used to be, clearly, with milk prices having come off their record highs. So painful time right now for producers. I'd say with all that bad news, we got into with the positive story. We had record exports last year. That's a win, and hopefully with declining dairy product prices, we're going to see a stronger export pace. When we are struggling with still a fairly strong dollar, hopefully our lower export or dairy product prices are going to buy us a little bit more market share globally. That's taking the long view. Hopefully we can expand our market share longer term, but sometimes it just takes a period of low prices in order to do that.
Right on. Okay. Well, good stuff as usual, Tanner. Folks want to reach out to you and get more information about what it is you're doing over at CoBank. What's the best way to do that?
You can go to cobank.com, COBNK.com, and you can find our research at on the Knowledge Exchange tab.
Right on. Okay. Man, I appreciate you being on the podcast, man.
Hey, always glad to be here.
Thanks, man. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast and check out the video version of this over on the YouTube channel, which is the Moving Iron Podcast YouTube channel. Check that out there. Go to Moving Iron LLC for everything Moving Iron related and get all the information from the Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. If you want to get $50 off your registration fee, just be the first 150 people to sign up, and Axon Tire will take care of that for you. So with that, I'm Casey Seymour with Tanner Ehmke. Let's do some iron, folks. Out.
Moving iron in the 21st century. Hard work.